We absolutely have to care. People your age who believe, who are counting on Medicare, Medicaid, Social Security, if they're government workers, their pensions, need to understand that past is not prologue. They may deserve it, they may want it, but they're not going to get it. They need to take care of themselves because society is going to be unable to afford to take care of them.
Right.
Whether or not they experience it in 2024, 2025, or 2026, they are going to experience it. Even people my age need to understand that although they may believe that they're entitled to entitlements, that we're coming to a point in time very soon where they won't be affordable. How will they deal with it? Well, they will certainly raise the qualifying age. They have to do it. When Social Security was instituted, the average life expectancy of an American male was 66 years. And Social Security covered you after age 65. There was a 1-year liability. No longer the case. They'll have to means test it.
Yeah.
Which is to say, rich people like me need to understand that they're going to pay in a lot more than they're going to get out, and they're going to be mad about it. Yeah, absolutely. Now, the way that's sold is that it's insurance. That's wrong. It's theft.
It's kind of generational theft, too. Like, if we're paying for it.
It's absolutely counter-generational, and your generation should be pissed.
Yeah.
My generation voted themselves all these cool benefits, but we forgot to pay for them. So we get all the cool stuff, and you all get the bill.
With US government debt now reaching a staggering 120% of GDP and unfunded liabilities, climbing beyond a jaw-dropping $100 trillion, Rick Rule delivers a stark warning. The financial trap is being set, and most of us won't see it coming until it's too late. The government is quietly laying the groundwork to means-test entitlements and raise taxes, especially on the wealthy, presenting it as necessary reform. But beneath the surface, this is nothing short of generational theft. While the older generation continues to enjoy the benefits, the burden of paying for them falls squarely on the shoulders of the younger generation. They'll end up contributing far more than they'll ever get back, all while thinking their savings and investments are safe. It's a hidden form of asset confiscation, disguised as policy, that few are prepared for. Rick Rule's insights shine a light on the dangerous path the US economy is treading, a path that could lead to a massive and unforeseen wealth transfer. The real question is, will you be ready when the trap is sprung? This is a wake-up call for anyone concerned about their financial future. Protect your assets before it's too late, and ensure you're not caught off guard by these impending changes.
I think these wake-up calls are very useful, and in fact wholly beneficial, although they're painful. The unwinding of the Japanese carry trade has been baked into the market for 30 years, but because it didn't happen until it didn't happen, nobody cared much. The idea that Japan could run up very large current account deficits while still manipulating the interest rate lower, and could deliberately manipulate their currency lower to increase exports, gave rise to a circumstance where big Japanese banks could borrow money at a very low cost in a currency that was guaranteed to go down, and reinvest that money at higher interest rates in a currency that, at least relative to theirs, would go up. That can't last, nor can government debt at 300% of GDP last. But because it went on for so long, because there were 3 decades of built-up savings in Japan, people didn't pay attention to the warning signs until the trap was sprung. This happens again and again and again. It has been said there's only 7 basic lessons of investing. The difficulty is that you need to relearn all of them in sequence once a decade. And so I think it's important that people look at the events of last week and understand how forecastable they were, and understand that there are other lessons in the market too that we don't pay attention to until we have experienced them. And that is very useful. When people look at the US economy, they say, well, why should American debt to GDP at 120% be problematic? The Japanese ran for a long time, over 200. It went on until it didn't. The Japanese individuals had much higher per capita savings than the Americans do, and hence they could afford to be stupid for longer. But when the string plays out, the string plays out. Julia, I remember, and you'll understand where I'm going with this in a while, being not unsophisticated financially myself, driving 20 years ago, and seeing a big billboard on my right, on the right of the freeway, that said, borrow 125% of the value of your home. Bad credit, okay. And I remember as a lender thinking, I'm not sure this works out okay. But I didn't correlate that complacency with the crash of 2008, although they were directly correlated. It turns out that people don't pay too much attention to warning signs that are statistical until the trap has already been sprung. I'm not suggesting, Julia, that people should go out and look for catastrophe and, having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency. That's all I'm suggesting. And I think that the events of last week likely make your audience a fertile resting place for that admonition. 2 risks and 1 opportunity. The risk is the fact that most people believe that they enjoy a real yield on US dollar denominated deposits. When people in the United States look at inflation, and when people in other countries look at US inflation, they rely on the CPI. The slogan for that is that it's the CP lie. It doesn't measure the deterioration of the purchasing power in US dollars. It doesn't include, as an example, food or fuel. Julia, if you look at me, you can see that I like to eat. So an inflation index that doesn't include food is of very little use to me. But more importantly, it doesn't take into account tax, the largest household expense of most working households in the United States. When I calculate the increase in the price of the goods and services that I use to live, including government, which is neither a good or a service, what I see is that the purchasing power of my earnings and my savings is declining at 7.5% compounded a year, not 2.6. If I juxtapose that with the yield available on my savings in the US 10-year Treasury at 4.3, rather than earning the delta between 4.3 and 2.6 as a real yield, I'm losing the delta between 7.5 and 4.4. And what that means to me is that the natural direction of interest rates is higher, or the natural direction of equity prices is lower, and that people need to pay attention to that. That's, I think, really the first thing that I look at. The other is related to it. It's the inexorable increase in government debt. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. On-balance sheet liabilities of the U.S. government in 2008 were about 25% of GDP. On-balance sheet liabilities of the U.S. federal government now are 120% of GDP, almost 5 times higher. That is concerning. It doesn't concern most people because they're more attracted to narrative than arithmetic. But people need to pay attention to arithmetic. Even more challenging for me, though, Julia, is the incredible expansion of the net present value of unfunded liabilities in the United States, entitlements. The Congressional Budget Office estimates that over $100 trillion in promised entitlements, Medicare, Medicaid, federal pensions, military pensions, exists today, which means that we're $100 trillion net present value behind the 8 ball. And nobody pays attention to this. We're trying to service $35 trillion in on-balance sheet liabilities and $100 trillion in off-balance sheet liabilities with a budget that is itself in deficit $2.5 trillion a year. We don't care because the trap hasn't been sprung. The Japanese didn't care until last week. We absolutely have to care. People your age who believe, who are counting on Medicare, Medicaid, Social Security, if they're government workers, their pensions, need to understand that past is not prologue. They may deserve it, they may want it, but they're not going to get it. They need to take care of themselves because society is going to be unable to afford to take care of them.
Right.
Whether or not they experience it in 2024, 2025, or 2026, they are going to experience it. Even people my age need to understand that although they may believe that they're entitled to entitlements, that we're coming to a point in time very soon where they won't be affordable. How will they deal with it? Well, they will certainly raise the qualifying age. They have to do it. When Social Security was instituted, the average life expectancy of an American male was 66 years. And Social Security covered you after age 65. There was a 1-year liability. No longer the case. They'll have to means test it.
Yeah.
Which is to say, rich people like me need to understand that they're going to pay in a lot more than they're going to get out, and they're going to be mad about it. Yeah, absolutely. Now, the way that's sold is that it's insurance. That's wrong. It's theft.
It's kind of generational theft, too. Like, if we're paying for it.
It's absolutely counter-generational, and your generation should be pissed.
Yeah.
My generation voted themselves all these cool benefits, but we forgot to pay for them. So we get all the cool stuff, and you all get the bill. Well, you know, we make a lot of noise about the fact that we're leaving you guys between 140 and 150 trillion dollars worth of investment assets, and we ignore the fact that we're leaving you 135 trillion dollars in liabilities.
Yeah, the liability side of it.
Correct. Yeah. So, and I'm not saying that people curl up in the corner in fetal position and think about this. I'm just saying that they think about it.
Yeah.
I think the third thing that I want to leave people with is on the opportunity side. Traditionally, during periods of time when investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities, the primary beneficiary has been gold. Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially under-owned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold, but I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant.